We're at a convergence of factors driving nearly unprecedented levels of transaction activity for private companies. Strong economy, low interest rates, plentiful debt and equity capital to do deals, potential higher tax rates in the future driving urgency, baby boomers retiring and wanting to sell their companies to fund their next chapter. The list continues. So if you feel like you should be selling now, or you're wondering if something's wrong if you're not getting emails and calls to sell your business, you're not alone. The fear of missing out, or FOMO, on the M&A boom is probably more common than participating in the boom itself. First, let's unpack this a little bit. Lots of baby boomers are moving into retirement, and many of them were entrepreneurs. So it stands to reason that there are now, and will be for the next decade or so, lots of founders looking to sell or monetize their biggest asset, their business. Second, the number of financial buyers, like private equity firms and family offices with private equity-like models, have exploded, partly in response to the desire for higher historical returns enjoyed by leveraged buyouts, partly because public equities are a little expensive, partly because there's cheap debt available to lever their capital and returns, and in no small part because they've anticipated the proliferation of businesses needing or wanting an exit. In other words, those two first things are connected. Add to that the short fuse these financial sponsors promise investors to put capital to work in 3 years or they have to return it, or in the case of SPACs, the need to deploy it even faster, and you have plenty of demand for deals. Now that's great if you're a potential seller. So why aren't you hearing from them? Well, there's a couple of potential reasons. Maybe your business isn't showing up in the databases that they use to find companies. It's unlikely, but it's possible. Or maybe your business has a lot of cyclicality, or it's project-based, or it has a need for heavy capital expenditures, or it's otherwise less smooth and systematic in the way that it grows. Your business might be too small for their models, or it might be some combination of those factors. Financial buyers are often looking for so many of the same characteristics, like 2 million or more of EBITDA, those transferable economics, subscription-based or systematic revenue, low need for ongoing capital, high margins, bountiful growth opportunities to build the business from 2 to 5 million of EBITDA to 10 million. That's the model for so many of them, it's hard for even us to differentiate them. And they're all calling the same companies. So you're reading about and hearing about business owners whose businesses have those characteristics getting tons of unsolicited offers. And it feels like you didn't even get invited to the coolest party around. That's because there's a lot of buyers looking for a narrow range of deals and ignoring great opportunities like your business. They'll get to you, either because they get smarter or because you help them find you. Maybe both. And take heart, it might not be the right time for your capital event. And many of those deals you're hearing about are either getting retraded, in other words, priced lower by the buyer after some diligence, or not going forward after initial contact. Make no mistake, lots of deals are getting done, but the signal-to-noise ratio is low, so you're hearing about much more activity than may be ultimately happening. If you really want to sell your business, this is a great time to get an idea of valuation, and it may be a good time to sell. But the opportunism of selling because of those factors I mentioned initially will probably pale in comparison to getting your business to the right level of economics and transferability to optimize your sale price, your terms, or control of your legacy. Don't let M&A FOMO cause you to rush to market.